Well, good morning, everybody. We're just waiting for a few more people to join, and we'll start the panel session in a minute or so. So just as people start to join in, yeah, they're coming in there. Well, I think we'll kick off with what we've with the panel now. First of all, introductions. My name's Rob McCoy, the Senior Product and Business Manager at TMA, and delighted to be able to host this specialist lending panel today. Our experts on the panel, from Bluestone, we've got Chris Kirby, Head of Sales, Retail Mortgages. Bluestone is also part of Shorebrook Bank, so and partner with the mortgage lender. We've got Fleet Mortgages, Wes Regis, National Account Manager there. From Lendinvest, Rod McPherson, Head of Distribution. From Quantum Mortgages, Zoo Marman, I think I said that right, National Account Manager. And first and finally, apologies from Brad Rhodes at Pepper. Unfortunately, he's not been able to make it today due to an unforeseen circumstances, and we weren't able to supply get a replacement quickly. So it's just the four experts that we've got today. So we'll kick off straight away. And we'll start looking at the residential market, and the fact that affordability seems to be the biggest obstacle for many applicants. So what are the lenders doing to help overcome this? So, is there examples of increasing either income multiples or improving the affordability? And what more can be done to help first-time buyers? So, Chris, would you like to have a stab at that first off?
Yeah, of course, happy to. And morning, everyone. Thanks, Rob. So I think when you look at, what is affordability, there's a number of factors that go into affordability. And one of those is, you're absolutely right, is income multiples. So at the moment, at both TML and at Bluestone, our income multiples are 4.5. It is something that we are, like with everything, is constantly under review to make sure we're providing as much choice and optionality for brokers and ultimately their customers as possible. I think the other aspect to affordability is actually making sure that as a broker, when you're speaking to customers, we're maximizing the income. And by that, I don't mean obviously artificially inflating their income, but understanding which lenders will consider which incomes, because it may well be that if you can find a lender that will accept more income, even if they do have a multiple such as ours at 4.5%, because they're using a higher income, actually you get a better affordability result as a result of that. So, that could be, as a bit of a plug for ourselves, that could be lenders that use 100% of overtime, commission, bonuses, second jobs. Or if I look at it from a self-employed angle, TML will take the net profit before tax and salary for a limited company director. So if you've got £100,000 profit before tax, after tax, that's around about 77,500. So TML, we're actually including an additional £22,500 of income at the top end. So it's all about the ways to maximize affordability for your customers, is making sure you understand which lenders can support and which lenders will not only look at higher multiples, but also which lenders will include as much income as possible. And then I guess there's other things that lenders can be doing, but they sort of go hand in hand as well. So it's looking at higher LTV. So there's some lenders out there that do, you know, maybe up to 100% loan to value, others doing 95%. And that's great. And it's really good. It gives more options for customers. It's all about sort of marrying that up and making sure that you've got not only the small deposit solutions, but also the affordability solutions and maximizing the income as well as the multiples to get the level of borrowing that your customers need and that they want.
Rod?
Yeah, Chris is exactly correct. So brokers, it's incumbent on them to know what lenders are going to do what, exactly that. I would say that there's everybody's involved in the process. So the client needs to put themselves in the best situation possible in order to be able to get the most affordability. So talk to an advisor early. I think that's always very, very important. There's very basics that brokers can do, just extending the mortgage term. I'm an ex-advisor myself. Extending the mortgage term, finding a lender that will go out to as much as 40 years. I never like to go into 40 years, but it's there for people that want to. I always found the difference between 35 and 40 years didn't make a massive difference to the monthly payment, but it massively increases the amount that you're repaying. So I tended to cap out around about 35 years. Same as Chris, we'll do a whole bunch of things. We'll take 100% of bonuses. We'll take job income from second jobs. If a client's repaying a credit commitment, we're one of those lenders that will just completely ignore a credit commitment. The question is really centering around about income multiples. Yes, Lend Invest absolutely will look at income multiples where we can do. So imagine you've got a situation where you've got Mr. and Mrs. Mrs. is an NHS dentist, and a year ago she started one of those aesthetics clinics, and she's bought a bunch of equipment on credit cards in order to get the business up and running. She started that as a limited company. Mr. works in town, doing a job in admin, and he's also getting some personal independence payments, so there's a bit of benefit there. So it's come a year later, so we're a year down the road. What as Lend Invest as a lender, what are we going to use for affordability? Well, first of all, we'll obviously take her NHS salary. She's only been self-employed for a year, so we're perfectly fine with that. We'll do that, no problem. Mr's job, we're going to take all of Mr's job's income. We'll take most benefits at Lend Invest. I'm always going to recommend talking to a specialist lender before you submit an application to get to understand the appetite. As I said, if the credit commitments are being repaid, we're going to completely ignore that. We'll take all of that income, add it all together, and they'll get a 6.49 times income multiple because she's a qualified professional. So yes, there's the affordability there because we're taking all of the income on that enhanced income multiple. So we are trying our absolute best to see what we can do to help affordability. I'm going to say that we spoke about what advisors can do to help. We spoke about what clients can do to help themselves. I think it's also incumbent on the government to try and do some more to help out here. The biggest problem here really is what we're doing here as a sticking plaster. The more that we help affordability, the more that this problem persists. So we really need to put pressure on the government to get involved in some mass scale house building. None of this is going to change until we get a better supply of property. And then there's a whole bunch of other stuff that we can do that we'll probably touch on later in terms of stamp duty reform, etc.
Well, we're also, Rod, as well, we're in a situation where we haven't got a help to buy type scenario for the first time in, you know, a number of decades. There isn't a government recognised scheme to support, you know, new build slash first time buyers. So the other aspect is what more can be done to help first time buyers, you know. So TML and Bluestone, we both increased our LTVs up to 90%, applying those to new build as well. TML also does shared ownership, which has been a real success since we launched it 18 months ago to help first time buyers. Lenders and brokers can do so much, but I agree with your point there, Rod. There is an element of government support needed to sort of help the market in general, but especially first time buyers, because affordability can get you so far, small deposits can get you so far. But not saying we need a help to buy where it's a 20% government equity loan again, but I think something to help the wider market would most definitely be welcome. Whether we see something like that is a different situation, but it would be, I think, most welcome. Any support for first time buyers would be most welcome.
You're absolutely right. And help to buy, as I said, I was an advisor, and when I was advising, help to buy came round the first time round, and again the lack of supply married with help to buy it just ended up with prices just kept on escalating and escalating and escalating. So you ended up supporting the people that were buying on Help to Buy and excluding everybody else that's maybe the next time buyer, or if you didn't qualify for that Help to Buy scheme. So yes, I do like shared equity schemes. That's not the panacea though.
Yeah.
I think you know the one as well as help first time buyers. I still think there's probably more that can be done to help self-employed clients. You know, I know there's a number of lenders that will take just 1 year's accounts and things like that. So you know, I think there's still a little bit of a differential between what some lenders will do for self-employed and what they'll do for an employed person. And I think we need to start looking at that as well.
It's near enough half of what we do, Rob, on the residential side at Bluestone and TML. And you know, when you look at the UK workforce, it's only around about 15-16% of the workforce is self-employed. So that tells us that, and I you know, including Rod within this as well, you know, and other specialist lenders, it's an area of the market we're really, really good at. But on the flip side, it's an area of the market that's almost chronically underserved by your mainstream lenders. So, you know, I think the important message for advisors is there are lenders there to support your self-employed customers with 1 year's trading, with big jumps in their figures, and you know, who need their incomes looking at differently. It's making sure that you work with us a big, wide-ranging net of lenders, or obviously using the desk support and everything that you can provide at TMA to get pointed in the right direction as to what lenders can support.
Yeah.
Chris is right, but let's keep that a secret because I don't really want the mainstream lenders.
Well, you know, similarly, you know, we've got the affordability issues, but there's also many borrowers who are finding themselves with a minor credit blip or a little bit more serious credit problems. And I know if Brad was here today, he would be saying that, you know, it really does depend on what the credit file is showing, and you know that because certainly within their criteria, they have a lot of grey areas that they will and they won't consider. So it does, you know, use of the support desk at TMA is really important. But Chris, from your point of view, what is it that Bluestone can offer on anything like that?
Yeah, so I think adverse credit is something that's always been there, obviously. You know, access to credit is easier than ever before, I'd probably say. And I think if you look at what's happened over the last sort of 3 to 5 years, you've had a COVID pandemic, you've had the mini budget, and then you've just got the things that are almost, you know, universal, which is, you know, the geopolitical landscape of, you know, trade wars and what that has on prices. So inflation hit double digits not long ago, and obviously mortgage costs spike. So all of these things have seen an increase in adverse episodes for customers across the country. So I think the good news for brokers is that there are solutions out there. And again, it just goes back to my previous point of making sure that you're working with TMA, working with your BDMs, working with the specialist lenders to understand what those solutions are. I mean, just for some idea or some flavour as to what Bluestone can help you with, mortgage arrears, you know, we've done sort of like studies and surveys and shown that people will prioritize paying their mortgage above everything else. You know, so they're more likely to default on their utility bill or a car loan than they are on their mortgage. But some people will still miss their mortgage payments. From a Bluestone perspective, anything over 2 years ago is ignored from a mortgage arrears angle. So we're thinking, you know, when was the mini budget? 3 years ago. When were people maybe experiencing the pinch of their rates maybe increasing and inflation was high? It's around about that 2-3 years ago mark. So if they've had any arrears over 2 years ago, we'll ignore them. Then we can even consider mortgage arrears in the last 2 years. So you can have up to 4 missed payments in the last 2 years, as long as there's none in the last 12 months. So there's plenty of flexibility from that perspective. But then, as I mentioned, you look at then things like defaults and CCJ, so the more common types of adverse credit. So if you look at CCJs, there's over 1 million registered each year, which is an awful lot. And again, from a TML, from a Bluestone perspective, how can the two brands that I'm really, really lucky to represent, how can they support? Well, we allow 3 CCJs and 4 defaults in the last 3 years. Anything over 3 years, completely ignored. So you could have 10 defaults registered 3.5 years ago, totaling £20,000. That's the type of case that we'll look at. But on the flip side, you could have had 2 CCJs and 3 defaults registered 8 months ago, unsatisfied. That's the type of deal that we will be able to help your customers with. It's all about just, you know, tell us a story, tell us what happened. We want to understand it because we want to help your customers. So make it, rather than sort of like turn those cases away because you think, I don't think there's a lender there to help, speak to the help desk, work with your lenders and see what we can do. And then you've even got some things like, so that's like your more serious, so more significant adverse. But then when you're looking at things like blips, we get it, life happens. Sometimes it is just a bit of clerical oversight, for example. So we'll allow, you know, for example, on your unsecured commitments, we can have up to 2 missed payments per commitment in the last 6 months. So they don't need to be up to date. They don't need to be returned to a state of 0. But if they've missed a couple of payments in the last 6 months on a credit card, on their next directory, that type of thing, again, they're the types of cases that we can provide immediate solutions for your customers. So make sure we're not turning those customers away, because there's lenders like Bluestone, TML, and other lenders that will happily support those types of customers.
I've noticed from talking with Earl on the desk that, you know, they're starting to get a few more inquiries with minor adverse on, and one thing that seems to be coming quite regularly is people who have got parking fines that they're disputing and things like that. And he said to me, a couple of lenders have said, you know, we're just going to ignore those because we know how long it takes to resolve those disputes.
Exactly.
And it could be that it's irrelevant. It is something that keeps cropping up. Payday loans again is another one that pops up quite regularly as well.
Yeah, it's even things like, you know, like debt management plans, IVAs. Bluestone will consider a customer who's in an active IVA if they're raising the money to repay it, for example. So just because somebody's got a bankruptcy, got an IVA, they've got a CCJ from because of a parking fine, they've maybe, you know, defaulted on their mobile phone last month, or they've had a utilities arrears last month, for example. These are cases, they're just some examples of cases that we will help with. So there are lenders out there, so please don't discount those customers, because there are lenders that are willing to lend to them. Yeah,
absolutely right. Wes and Zoo, I'm not ignoring you, but we're going to turn to buy-to-let now. We'll get the mic off, Chris, and so it's you know, what I've heard being talked about, that the market's in suspended animation because landlords are facing increased taxation, possible extra taxation, and lenders are being a little bit more cautious. Have lenders been spooked by the? No, sorry. Have landlords been spooked by the Renters' Rights Bill? And are you seeing any evidence, or have you got any idea of scale of seeing landlords exiting? Wes, do you want to start off on that one?
Yeah, you broke up a bit there, Rob. You might have to stick your head out the window and get a better mobile signal with your laptop, but I think I got the gist of it. So in terms of suspended animation, that's a really easy one to answer. The answer is no. I mean, UK Finance's figures themselves, Q1 this year, 2025, show quite significant growth on remortgage and purchase compared to the year before, right? So we're not comparing it to a very good year, but it's significantly up, both purchase and remo, Q1 2025. If it was in suspended animation, 2025 would look just as depressing as Q1 2024, right? So very easy one to answer. Definitely not in suspended animation. Speaking about our business at Fleet, because obviously that's the data I've got in front of me every day, day in, day out. UK Finance's data is a little bit out of date because it was going back to early this year. We are growing compared to last year. Comps are up about 10%. So, you know, anything that's going in the right direction for me makes me more optimistic rather than going in the wrong direction. But that does tell me that the market and buy-to-let mortgage lending is not in suspended animation. I think the dynamics of it all, the mechanics of it all, have changed significantly over the last 18 months. And there's going to be certain lenders and brokers that are well positioned to capitalize on that shift, and there's probably going to be others that aren't in as great a position to capitalize on that shift. So the market is not in suspended animation, it's going in the right direction, and there's going to be some good winners within that and that shift, and there's probably going to be a couple of losers as well, and time will tell who those are. But those that are well positioned with good propositions, know what they're talking about, are good at what they do, will probably still have a lot of opportunity within this space going forward, for the foreseeable. It's a tricky landscape, and Zoo, I've listened to Zoo talk as well at events and things. He really knows his stuff, and he'll do a good job of going into some of the challenges that are probably over the landscape at the moment as well. So it's not easy, plain sailing, easy sailing, but there's a lot of opportunity out there for everybody that knows what they're doing. And on that note, I'll shut up.
Zoo, do you want to, your expert opinion on this, as Wes has made it, picked it up for you?
Yeah, I'm going to send Wes that cheeky check-in after this call, don't you worry about. But no, I mean, look, to echo on the back of what Wes obviously mentioned just there, exactly in the same position. When you obviously see lenders like Quantum, in terms of the growth that they've necessarily had, even within the last 12 months, if the market in itself was spooked or anything like that, then you wouldn't see the kind of portfolio landlords that we're seeing scaling up to the kind of size and seizing opportunities that they can have. Is it probably putting off the kind of new to market kind of buy-to-let landlords? Absolutely, probably because of how the media obviously portraying, it's all doom and gloom and all these potential new taxations are going to be implemented, this, that, and the other. But where we've probably seen a humongous growth, and funny enough, when you actually are seeing a lot of professional landlords now inquiring about these corporate let agreements. So where we've gone extremely heavy since the turn of the year is our appetite towards corporate let agreements with vulnerable tenant as well as assisted living providers. So traditionally, you would find very few lenders that would have the appetite for these kind of corporate let agreements with the likes of the Serco, the Mears, the Clear Springs. Whereas now, our kind of standalone policy is, even if the company is either on the CQC register or not, Quantum will permit those corporate let agreements with any vulnerable tenant provider in the UK. So I've had multiple portfolio landlords now look at it and go, okay, from a legality standpoint, those traditional kind of tenants, if these new measures get implemented, therefore a 5 or 7 year contract guaranteeing me almost double the market rent is now too good for me to look away from. So now you've also got the, those kind of landlords now that are really starting to educate themselves in that space. So if there's anything that I could literally pass on or emphasize to anyone that's on this call today is to go and do your kind of due diligence, educate yourselves in terms of, those kind of corporate let agreements that are in the market and are available now for landlords to take advantage of. Most tend to be absolutely beyond surprised when they see the kind of rates that they can get on those agreements, because traditionally, beforehand, it was always double the market average to do that. So again, it'd be not necessarily cost effective as such. Whereas now, if you're getting double the market rate, and the rate, shall we say, is 1.5–2% above the high street kind of lender rates, then the client, the accountants are looking at it going, actually, this is a very cost effective kind of way. From a risk standpoint, it's always the number one thing I always get asked. Oh, but Zoo, surely this is quite risky, this, that, and the other. But look, the proof in the pudding is you've got a 5–7 year contract there guaranteeing the rent from government back to organizations. So personally speaking, from my perspective, if that's my money that I'm giving to someone, I'd rather someone give me a contract like that rather than someone that could potentially go and lose their job in 2–3 months. And then therefore I'm going to have to go through the whole cost measures and legalities of trying to get that person in, obviously, to move out. So yeah, so there's loads of opportunities like what we're seeing, but those are the
just to quickly jump in there, Rob, just to back up what Zoo's saying, because we will look at corporate tenancies as well. We've seen quite a notable increase, not only in the business we are able to do, because we do have a parameters we have to work to. For instance, Zoo mentioned there, agreements up to 7 years. We'll only go up to 5 at Fleet, just so that, there are lenders out there that are built for this stuff. We are to a certain degree, but there's specialists that are built to go a little bit further than us as well. We have, that is a great example of what I mean when I said earlier that the dynamic's shifting. So there's opportunities like that, there's growth areas like that within the market that those that have got the knowledge and the know-how will capitalise on, and that's a perfect example. Serco, Clear Springs, those kinds of tenancies, we will do those. We see them a lot, especially in the Midlands and certain regions. So yeah, if you're coming across situations like that, speak to Zoo, speak to me, speak to the help desk at TMA, because there's quite a few lenders that will consider these now.
I was going to ask, so where could brokers get information about what the propositions for Serco and the likes are? Is, you know, can they just reach out to those companies direct via a website or something like that to get that information?
I mean, look, they most certainly can, but then at the end of the day, it'd be a discredit to people like me and Wes who are available in the market for them to obviously get that education from, if I'm really honest with you. We can obviously instill that kind of information at the front end and then obviously advise them in terms of where we could even, you know, to be fair, Rob, I probably get about, without even exaggerating, probably 150, 200 leases presented in front of me on a weekly basis. And these are draft copies. So even if a broker was even say to me, what do they even look like? Could you even run it through with me? I've got those leases at hand to go, these are exactly what they would look like. These are the clauses to look out for. So in a way, it's not necessarily me trying to turn a broker overnight into a conveyancer, but fundamentally, these are the type of cases where, you know, it can be all smooth sailing, but then it can go flat on its face when it gets to legals. So again, it's just about them knowing and understanding on how to advise their clients on how best to approach these. Even from, funny enough, even from a conveyancing standpoint, it's one of the biggest things that we've always emphasized from the get-go is we've got no restricted conveyancing panel. So therefore, we'll allow them to have their solicitor to act on a dual rep basis. But to stress on that point, when you venture off into this space, it's all very well getting a conveyancer that's looked after their affairs for the last 15 or 20 years. But if that person's only been looking at Halifax and NatWest and nationwide kind of mortgages put in front of them, then when they get like a quantum offer document in front of them that's got a Serco lease attached, then you're like, oh, what's going on here? So, you know, the fact that you've got that whole of market approach where you can go to any conveyancer, all I would say is it enables you to have those very frank conversations with the legal side of things before you even proceed with the application. So they can obviously preempt any concerns or anything that they believe that they would need to see on the back end, rather than traditionally what's tended to happen is a client's gone and forked out a substantial amount of money throughout the whole application process. They pay the hefty valuation fee. And then when it gets to legals, they're like, well, why didn't anyone tell me this at the front end? So those are the kind of stuff, to be fair, that, you know, me, Wes, and anyone that specializes in that sector within our space can obviously discuss with the brokers at the front end, and yeah, hopefully make it as a seamless process as a standard buy-to-let application.
Excellent. Rod, we've heard of one area of an opportunity in the buy-to-let market. So where would you see? Is there any other opportunities that you want to shout out in the buy-to-let space?
Yeah, absolutely. So there's two main points I'd like to cover in this, and I say two main points because at my age I need to remind myself what I'm trying to talk about. It's not just for your benefit, it's for my benefit. The first point is your original question was around about the Renters' Rights Act, because it's an act now, isn't it? It's gone to relative.
Yeah.
You may have picked up from my accent that I'm not from Watford, so I would argue that Scotland is living in the future, because we had in 2016 the Private Housing Tenancies Scotland Act, which has done what this Renters' Right Act is going to do. So we're basically a blueprint of what's about to happen for the rest of the UK. And there was two things that happened in Scotland. So first of all, there was the Private Housing Act, but then there was a second thing. There was a 2022 emergency rent freeze. So we had all the rhetoric that you're all going through at the moment around about there's going to be a landlord exodus, everything's going to go wrong. Let's phrase it that way. So what we actually saw was there wasn't a mass exodus. It disincentivized amateur landlords. So the people have ended up being an accidental landlord, they exited. I think that's probably right and fair, because those people, they're not really offering a quality service in some cases, not in every case. The second thing that happened was rents continued to rise. I think everybody was worried that there was going to be a cliff edge exit of landlords, so that would mean that rents would absolutely skyrocket. That didn't happen. It just, rents continued to keep on going, and it just ended up professionalising the whole market. So that's the first point that I wanted to cover off, is that we're probably needing to exercise a wee bit of caution in terms of all the rhetoric that's going around in the trade press. Secondly, your question was, is there still opportunities? Yes, there absolutely is. There's loads of opportunities. So if I sort of summarise it into a couple of different things. So first of all, landlords probably want to go north. The ones that have centred around about London are probably going to struggle a wee bit, and they probably want to go north because the northeast, for instance, represents really good value, really good yields. Scotland offers very good values, very good yields. They probably want to go green. So you've got EPCC coming up. And even if you don't, it just makes sense to do it, right? So I know we're going to talk about bridging at some point in the future, so we'll leave that for a discussion a wee bit later. So go mixed use. So the professionalised landlord is going more towards a more semi-commercial property investment. So they're getting the double hit out of, you've got property above, you've got commercial below, and that makes you exempt from a 5% stamp duty surcharge. And the final thing that I would say is the landlords probably want to go HMO. And that's a good segue for me, because we've got a webinar coming up titled "The Only Way is HMO." So I would encourage you, to anybody that's interested in finding out more about our HMO proposition, or just HMO in general, to jump onto that. That's a massive growth area for us. We're just seeing huge amounts of HMOs coming in, HMO applications. In Scotland in particular, we've seen a lot of those types of applications around about university towns. So we're seeing a lot of students going to those. Tends to be foreign national students. They seem to pay in an unendless amount of money on a monthly basis for their rents. But also we're seeing a lot of the professionalised landlords, what they're doing is they're creating high quality stock, and they're making sure it's got a working environment. So people that want to work from home, it's got a good quality office, good quality broadband, good desk space, etc.
You've touched on bridging, so let's move into that area as well. So you know, what would you say about anybody who wants to look at the bridging market and what they could do?
Yeah, so I mean, Lend Invest, our roots are bridging. We were formed in 2008 with two guys with a wee bit of money that could see an opportunity in the financial crisis to be able to make some money out of bridging. And we've been doing it since the inception of our company. So I would say that Lend Invest has got two fantastic propositions in terms of, one, if you're split new to bridging, you've never done bridging before, you've always referred it across to a packager, nothing wrong with packagers, keep doing it. If you're happy doing it, that's fine. But if you wanted to do bridging yourself, and there's a lot of good reasons you want to do it, because maybe you want to keep control of that application. So our system has been designed, we're kind of effectively a fintech, and our system has been designed around about making your life and the client's life as easy as possible. So if we had a broker who wanted to do bridging that didn't know anything about bridging, that had a client sitting in front of them and they were registered with our portal, they could go in. The system asks questions. It's just 10 clicks. So it's basically, what's your client's name? What's the property worth? What are they paying for it? What's the end value going to be? There's a free format box. You can put information in there. Click send. 90 seconds it takes to fill in that form. And within usually an hour or less, you'll get heads of terms. If you're not familiar with bridging terminology, that's very similar to decision in principle. You'll be able to present that to your client. It'll show all the costs, exactly everything you need to know around about what a bridging inquiry looks like. So if you're interested in bridging, I would encourage you to reach out to one of your Lend Invest BDMs. We'll make your life really, really easy. And then the second part of it is the brokers that are already doing bridging, we make their life really easy with automated valuations. So we'll do AVMs where we can do. So when you key that inquiry, it'll run the property through to see whether it can do an AVM or not. The portal that we've got gives complete transparency. And the product range that we've got is absolutely fantastic. So for instance, if you've got a client who's seen a property at auction and they want to be able to buy it, they'll be aware that there's a really tight 28-day auction deadline. If you get us involved early on in the process, we'll guarantee to get an offer out to that client and completion within 28 days. We're also we're very popular with brokers who have clients that want to do light refurb. So this refers back to the comment that I was making before. So in Scotland, we've seen a lot of brokers, and what they're doing, a lot of landlords, sorry, what they're doing is they're seeing a property in their town. Typically, it's going to be somebody who is in the trades. So imagine it's an electrician. They've used a broker to arrange their own mortgage, the residential mortgage. They've seen a property that's up for sale. It's not habitable, so they're not going to be able to get a residential mortgage or a buy-to-let mortgage on it. Say it's up for sale at 120. They've negotiated that they'll be able to get it for 110. They know they can do the work in 3 months, them and their pals, and they'll get that property value up to £200,000. So we'll do the bridge on that. We'll do a light refurb bridge up to 85% loan to value, and then we'll allow that client to exit at the back end of it. If they want to retain that property and rent it out, we'll do a bridge to let property that we will offer incentives. So we'll give them money towards legals, we'll give them money towards the valuation, and we'll make that process really, really easy to be able to exit out onto the buy to let. So we are absolute experts as far as this is concerned. I think if you are in bridging or want to be in bridging, you need to get in touch with your BDM for Lend Invest, just to get to know what we are doing.
Zoo, your Quantum recently launched into the bridging space via the clubs. So, why did Quantum do it? Was it just seeing the opportunity, or what?
Why not? Look at Rod's explanation of bridging. How can you not get involved in bridging? No, I mean, to be fair, when you think of the kind of quirky property types that we would necessarily do, traditionally, to be honest with you, there literally would be only one other last lender that a broker would necessarily revert to if Quantum can't necessarily lend on that property type. But at the same time, you've got phenomenal opportunities where an applicant necessarily wants to go and purchase that property at below market value. So therefore, let's say, the property is worth £500,000. They're getting it for £350,000. From a bridging standpoint, we'll go up to 90% of the purchase price. But the key USP there from a Quantum standpoint, and again, it's just leveraging that against the kind of stuff that we've had implemented from our buy-to-let kind of criteria from day one, is they can do a day one remortgage on that open market value with immediate effect. So in essence, you're getting 90% to purchase that 350, but then within 24 hours of completing on that bridge, we can use the same valuation report and do 75% on that 500. So most lenders would insist that either the applicant needs to have owned the property for a minimum period of 6 months to use that uplifted value, or that they would have had to carry out some works or have a schedule of works to justify why they're going to use that uplift. So this is where, the quirks of going to specialist lenders and speaking to lenders like ourselves has a huge impact, especially on these type of portfolio landlords. Because, when we discussed a short time ago about opportunities, yes, just as like what me and Wes touched upon, there's so much business and volume going on in the market, but there are landlords, experienced landlords, that are like, do you know what? I've had my day, I've had a good time, but enough is enough. I want to step out of the game. And therefore, then you've got other portfolio landlords that are looking to acquire their properties. I'll touch upon it as we discuss other potential opportunities, but, one of the big areas that we've seen, especially that complements quite well with this whole buying below market value, is share purchases. So there's very few lenders that necessarily have ventured into that space. So we'll even facilitate raising funding for that applicant to purchase the limited company that actually holds all the properties within it. So from a tax perspective, the applicant is only going to pay 0.5% on the purchase price of what they're actually buying the limited company for. So if the property portfolio, let's say, is worth £2 million, but the applicant is buying it at 1.5 million, we'll allow them to leverage off that £2 million value literally the next day that they could then go and purchase it. So it's those kind of unique kind of strategy and points that we're looking at, because, with all these implementations and stuff that are going to be brought into place, landlords are now going to become even more savvier in terms of how to acquire these assets and how to grow their portfolio. And then, you're just going to have to obviously refer it to obviously specialist lenders that have the appetite to obviously go into that space. And bridging, to be fair, just complements that. And the fact that, you know, we would never complete on a bridging loan unless we can guarantee exit at the very least onto a quantum buy-to-let mortgage. So I think a lot of the time when you do speak to some brokers that aren't well versed or very well experienced within the bridging space, maybe they had 1 or 2 experiences in the past and they weren't great experiences, or maybe their client did get that bridge, but then they were stuck on that bridge and they couldn't exit them out. So the fact that they can go, you know, to lenders like LendInvest or like Quantum, where they both do buy-to-let and bridging, then they have that added assurance of going, okay, at least I've got an exit strategy here. I'm not going to be left in a position where, you know, my client's going to be on this bridge and I've got nowhere to go. So that hopefully will instill confidence as well in the brokers referring to lenders like ourselves, to obviously, do the whole kind of holistic approach on both sides.
I mean, one of the things that we haven't touched on is obviously the amount of maturities that are coming up next year. You know, in the buy-to-let space alone, there's something like 76 billion worth of lending that's maturing next year. I think overall, including all the residential, it's around nearer 430 billion this year. So, you know, it's a sizable piece of that market that you know, people will be looking for advice on what to do with the rates they've got maturing at the moment.
And just following up on the other guys, Rob, as well, and going back to the bit I mentioned earlier about, you know, the mini budget and the knock-on effects of that. A lot of these maturities are going to be coming off quite significantly high rates as well. You know, rents will have increased, property values will have increased. So you'll find that with your landlords, their borrowing power will be significantly stronger now than maybe what it was 2.5 years ago. And just sort of mirroring what Rod and Zoo have both said, and I know sort of Wes will sort of like have this same view as well, is that the market, the buy-to-let market isn't dead, isn't dying by any stretch of the imagination. But I agree with what Rod and Zoo have just said. It is becoming, it's more professionalised. You know, your dinner party landlords, your let to buy amateur landlords, they're the ones that people are exiting, are more inclined to. But we did like a real life lending survey a year ago, and over half the landlords that we spoke to said they're going to expand their portfolio. And it was only a third that were looking to offload properties, but that wasn't offload and exit. A lot of them were, I'm going to offload a certain property because I want to invest in something different. I want to invest in something that's higher yielding, like my HMO. So we've seen a big rise in HMO lending, but equally others are going down the route that Rod and Zoo have alluded to, is I'm going to bridge, I'm going to get a property, I'm going to develop it, whether convert it or do it up, and then I'm going to extract as much as I can from its uplifted value, and almost rinse and repeat that same tactic. So from a buy to let, bridging is a fantastic opportunity. As long as as the guys have said, as long as you've got an exit, then it's great. You know, like putting my TML hat on, we do day one remortgages, for example. And obviously, like Rod and Zoo have mentioned, you've got the solutions there. If you can bridge to a mortgage with the lender as well, that's potentially a good option as well. So yeah, that market is by no stretch of the imagination is dying. All it is, I'll say, with the renters' rights bill, which is obviously very, very fresh to everybody, it's just an additional consideration. I think we can all agree that landlords want to provide, the vast majority of landlords want to provide good quality accommodation. Tenants want good quality, affordable, energy efficient accommodation. So yes, there's additional cost, whether that's stamp duty or taxation. It's just an additional cost for landlords to consider. But if landlords do exit the market, all it will do from a supply and demand perspective is reduce the demand. The supply is still going to be there, if not increase. So rents are only going to increase, if anything. So it's still going to be an attractive investment option for those more seasoned professional landlords.
You say they want to. I think they are. I think the majority of landlords are already providing service at a level that's going to be compliant with the new Act.
Absolutely.
Absolutely. And if you actually look at the number of properties in the PRS, it hasn't changed in 6 or 7 years.
Yeah.
Right. So the number of private rental properties are exactly the same, but we know that the amateurs are leaving. We all see it. Everybody on this call sees it, right? So that you don't need to be a rocket scientist to know that means that the number of customers to go at are less, but the ones that remain have got more.
Yes.
And we see it. Our average customer now has 12 properties. That's the average. So half of the customers we're dealing with have got more than 12 properties on their portfolio already. Dial back 18 months, 2 years, that was 8.
Yeah.
So that's in the last couple of years, that's the switch. 80% of what we do at Fleet's a limited company. Now, we're good at doing limited company. We've got some good pricing. We're good at processing it. So we probably get our unfair share. But that still tells me that talking about these dynamics, these shifting dynamics that we were on about earlier, that's the way the market's shifting. And your typical professional portfolio landlord with 15, 20 properties is going to be a limited company. So that's another opportunity, Rob, to go back to opportunities. If you're not looking at limited company, you don't know what you're doing when it comes to buy to that limited company, you need to speak to everybody on this call and figure it out, because you're missing a trick. But that's the reality of the market we're in. The number of properties is similar. It's a supply and demand imbalance. That's pushing up rents. There's not enough of them, as Rod said earlier. The government's got to start building more houses, which they've got a target, and that's what they want to do. But that's pushing up the rents. That's pushing up the income side of it. That's helping the affordability side of it. That's helping the loan size side of it. At the same time, mortgage rates are coming down. We've got 2-year fixes at 3.5% now. It is creating demand for the right type of landlord customer, which is the professional.
Yeah. Let's move away from products and markets in particular, but we hear a lot about AI in the industry, and how it's improving efficiency. But can you share with us what you're seeing brokers use AI for, or what you're using AI for? I was going to say, Chris, do you want to start us off on that?
Yeah, I think if there's one thing to take away from today is don't fear AI. I think that's the big thing. Is it's here. It will evolve. It's here to stay. But it's really, really important, whether it's brokers or lenders, is see it for what it is, and that is it's an enabler. It's not a risk, but to customers needing human advice, especially in our world, the people on this call, the specialist world. That is where advisors add real value to customer journeys and to the housing market in general. So, for example, it's not specifically AI, but just sort of to give you an idea of some of the tech pieces that we've been doing at Shawbrook Retail, which is obviously Bluestone and TML. So we've brought in efficiencies like AVMs. We now have DocuSigns. So there's no need to send off a declaration and get it signed, upload it. When you get it back a week later, it's literally just an email to the customer, electronic signature, and off you go. So those types of things are saving time. They're providing efficiencies for customers, for brokers, but also for us as lenders. We've also got open banking. We've got auto income verification. So, for example, it's about 40% of our residential cases, we're able to verify some or all of the income on an application without needing to see a payslip, without needing to see the accounts, without needing to see a tax year overview, for example. So again, these are providing efficiencies for brokers because they've not got to wait for customers and chase customers for documentation, but they provide us as a lender an efficiency as well, because it means we can process more work, process more applications with the same head count that we've got. So it's all about looking at what AI can do to sort of make things easier, make things more efficient. I think as a broker, you can almost look at the way we're looking at it as a lender is what can we use AI to do that is a manual process at the moment, and by doing that, it will enable you to effectively free up either people or free up your time to do what you're good at, which is serving customers, writing business. And if you're writing more business, you're making more money. So if I look at it from what are we looking at from an AI perspective, some of the things that we've been trialing is we've got a help desk, fantastic help desk in Sheffield for Bluestone and a fantastic help desk in Glasgow for TML. And we get dozens, if not hundreds of emails a day, which are case inquiries. So what we're sort of like testing and looking at is if we tell AI our policy to the nth degree, our lending criteria, can we run these emails through AI and can it answer them? Obviously, it's going, it's been tested at the minute. We're not sort of going to let it loose to the real world and everything. But what that will enable us to do is deal with more inquiries, help more customers. And that means our guys who are, in our telephone hubs, for example, they can be more efficient because they can deal with more inbound traffic coming in. And so what it enables us as a lender to do is we're going to use AI as an enabler to help us scale. We're not going to use AI to say, oh, we don't need people. we're going to be a company of robots with a handful of people doing things like this. No, the people are really, really valuable. Let's get the people doing what they're really, really good at, which is getting cases to offer, which is answering more queries, which is, you know, working in our completions team to make sure we can release more funds. So AI is going to be a real enabler for us to enable us to grow, but it's never, ever going to have the human element and the human oversight, which is really, really important to fundamentally make business happen and make deals happen and add value to brokers and their customers.
Yeah. I'm just conscious of time. Is it anybody else got any experiences of what they're seeing AI being used for?
Yeah, absolutely. So I mean, your question is two parts. What are lenders doing and what are brokers doing, or what could brokers doing? So lenders, we're only going to use it for two things, right? It's going to be risk management or it's going to be operational efficiency. So AI is not a difficult thing to do, actually. You just need to take Notebook LM, plug in your lending criteria, and it'll do most of it for you. So fraud detection is really good in terms of it'll interrogate a document and it'll tell you where inconsistencies lie. So yeah, brokers are going to be, lenders are going to be doing that. That's fine. Brokers probably are less interested in that. They're probably more interested in it, what's in it for them. So I've got a couple of recommendations, I would say. So first of all, I would recommend that you probably should learn about AI. What you read in the press isn't necessarily accurate. So I've currently signed myself up for an IBM course in the fundamentals of AI, and it tells you exactly what it is, where it comes from, what it can do for you, what it can't do for you, etc. So I think it's incumbent on brokers to learn about it. Secondly, they probably should take advice from their club network in terms of what security risks are involved here, because you definitely do not want to be putting client information or documents into ChatGPT. It's not locked down. You need to make sure you've got a locked down version of AI. So what are brokers going to use it for? So we absolutely love using Gemini to take notes at Lend Invest. And I'm going to recommend that that's probably great for brokers to be able to have something running in the background to take a transcript of the meeting. Because the amount of times a client will come back to a broker and said, oh, I didn't want this, or I said this in a meeting, you've got an actual transcript version of the meeting there itself. AI can help you with your CRM system, and it can do some intelligent fact finding for you. So there's a fair breadth and depth in what AI can do for a broker, and I'm going to encourage brokers to engage with it and learn about it themselves.
Wise words from the Scots.
I was going to say, Rob, I've seen the Terminator films, so, you know, that's what scares me.
So finally, the budget's coming up on the 26th of November, which happens to be the day before our annual conference. So that should make some of the panel sessions interesting, because what was prepared might not be, it might all change. But we've already heard some of the rumours that are going on, you know, property tax, scrapping stamp duty, national insurance on landlords, rental income and things like that. What rabbit would you like the Chancellor to pull out of her red box that will help the housing industry and the market get going? So let's start with Zoo first.
Do you know what? Literally, I saw the question and I was like, what would I want her to pull out the hat? To be honest with you, I'll look at it in a completely different way. I genuinely don't want her to pull out any God forbid, ghastly ideas or implementations of stuff that is just going to spook the market even more, to be fair. I think the worst thing that could happen right now is any kind of knee-jerk kind of reactions or implementations of policy that, you know, will just harm that kind of industry even more, to be fair. You can already see what the kind of Chinese whispers has necessarily done amongst a lot of landlords, even brokers, to be fair, because I think since the turn of the year, that's all it is. You turn up to like kind of lender roadshow events, this, that, and the other. You sit down at round tables. That's all people have been talking about all year. oh, what do you think it's going to be? And everyone's got their own concepts, ideas. Oh, I think it'll be this. I think it'll be that. The media just spits out new concepts every single week in terms of what Miss Reeves is going to necessarily do. So me personally, my dream is that anything that does get announced is as little as possible that doesn't already harm the market and just leaves it as is, to be fair, because you know, we've already spoken about the multiple opportunities that are at hand. And I think the worst thing that could happen right now, to be fair, is, yeah, a knee-jerk kind of implementation of a policy that is just going to do more harm than good, to be fair. So from my standpoint, I hope it's as little as possible.
Yeah. Wes?
Yeah, when I saw the question, this is the question I was fearing the most really today, because Zoo's kind of stolen my thunder a little bit there. We were all scarred, weren't we, in September 2022?
Yeah.
After a budget, and volatility, instability, lack of confidence, you know, rates up and down, impacting swaps going up and down. We saw the fallout. I don't think, you know, we're going to see that again in the near future, touch wood, hopefully, or ever again to that degree, to that scale. But just a bit of boring stability, which we have had for a bit of time now, and things to continue to move in the right direction is what I would like to see after this budget. But who really knows? I mean, I know you mentioned a couple of things there, like landlords having to pay national insurance. And also the stamp duty thing, I think it's interesting because it, correct me if I'm wrong, but it looks like that liability may fall on the seller rather than the buyer. So would that necessarily, you know, from a landlord point of view, would that put them in a position where they're going to be thinking, do you know what, renters' rights, it's all very hard. I've only got the one property because I'm an amateur landlord, but I'm also going to have to find an extra 20, 30 grand if I sell it. So maybe I need to just muddle on and push through this and, you know, figure it all out and keep hold of the asset. So there's all these potential things that might come out the back of it. But yeah, a little bit of stability would be lovely, a bit of confidence in the markets, and continue to see that base rate go the right way and mortgage pricing go the right way. That's hopefully what we end up with at some point. But I wouldn't bet me house on it.
Rod?
A three-pronged approach to stamp duty overhaul. So first of all, extending the first-time buyer relief. So we've currently got an extension of, or we're currently at 425. It'll go down to 300. I'd like to see that extended, just to try and encourage first-time buyers. Downsizers, so last-time movers, they need a wee bit of an incentive to move into a property that's more suitable for them, because we've got larger houses that are currently locked up because it doesn't make sense for somebody to downsize financially. So I'd like to see that a stamp duty reform to be able to allow people to downsize and get some relief on that. And the third one, which is completely wishful thinking. So we spoke earlier around about buying a property which is in a poor state of repair, refurbishing it, and then renting it out. So I would like to see some sort of stamp duty rebate. So you buy a property, and maybe it's EPC E, you work on it, you get it to EPC C or B, and then you exit onto a buy-to-let, and then you then get a rebate back because you've improved the quality and energy efficiency of that property. So that meets the government's environmental goals as well. So I'd like to see those three changes to stamp duty.
Okay. Chris?
Yeah, just very quickly. But it's my birthday the day after the budget, so as long as I don't get taxed on the £10 birthday money that I get, I'll be okay on that. I think what would be a couple of things. I touched upon it earlier. I think it'd be good if there were, I don't think we will see it, but it'd be good if there was something announced to support, you know, like the first time buyers or new build market from a help to buy new version. Not saying a 20% equity, interest-free equity loan for a period of time, but maybe 5-10%, something like that, that sort of helps stimulate that smaller deposit, higher LTV end of the market and gets more people looking at new build and just sort of looking at getting onto the ladder. Something like that would be welcome. I think stamp duty reform, you know, there's varying different options. The only thing I would say is if there is any stamp duty reform, just make it a permanent measure. Don't make it a temporary measure, because all we get is when you get a deadline put in place for a stamp duty, you just get a concertina effect in demand. So it means that the poor old brokers and lenders are really, really busy, and there's loads of pressure because we've got to complete by a certain deadline. And then it's a little bit of feast and famine. Then we go quiet for a couple of months because all we're effectively doing is squeezing 9 months of business into 4 months. So I'm open-minded as to whether we do have some form of stamp duty reform. Just if you're going to make any changes, just make them permanent. Don't make them temporary, because it causes everyone on this call a whole load of stress at certain times of the year, which we could do without.
Right. Okay. Well, we're almost at the end. So just a big thank you to all our panelists. I hope that the viewers have all taken something away from the sessions we've had. And if you have got any questions, by all means, drop us a line at the TMA Club, and we'll pass them on to the various panelists and get them a response back. It would be remiss of me not to say that about our annual conference. If you haven't already registered, it is on the 27th of November. It is in at the Vox Resort World in Birmingham. So yeah, there'll be similar breakout sessions with various panels and discussions going on, as well as a large exhibition area and 1 or 2 motivational speakers during the afternoon session. So once again, thank you everybody for attending. Thank you to our panelists, and have a good rest of the day. Thank you.
Cheers, Rob. Cheers, everyone.